Now, back to our conversation on taxes. Now, who here doesn't cringe when they hear the words Internal Revenue Service or IRS? I don't know about you, but I keep getting these letters from the IRS and I hesitate to open them because I'm scared to read what's inside, only to realize it's an informational letter. Now, was that even really necessary to send me that letter? Okay, so back to the topic for today's video. It's on required minimum distributions, which is a term coined by the Internal Revenue Service. And I'm going to talk about not only how it affects your retirement assets, but how it can affect your retirement income. So be sure to watch the video to the end because I think you'll find it interesting what impact a fixed annuity can have on your required minimum distributions. By the end of this video, I'll give you a better understanding of how required minimum distributions may affect your retirement and your retirement planning. Hi, my name is Darlene Hartman. I'm a CPA and financial planner, and I work with Money Concepts. For weekly retirement planning and annuity advice, be sure to subscribe to my YouTube channel. And don't forget, hit that notification bell so that you can receive notices when I post a new video. When do you have to withdraw required minimum distributions from your retirement account? Well, if you have a pre-tax qualified account, you're eligible to have to make those required minimum distributions. Now, why is that? Because a pre-tax qualified account is where you pay no taxes on the contributions made to that retirement account, and that account grows tax deferred over the years. So when you start withdrawing money from that retirement account, that's when you're going to pay taxes. Now, the IRS wants their tax money on that account that's been deferring over the years. So if you just sit on that money, then they're going to slap you with a pretty hefty penalty. And I'm talking about 50% of the required minimum distribution. So at what age are you eligible to have to make those required minimum distributions? That age is currently 72, but they do have current legislation which has not been, passed into law as of yet, which may bring that age up to 75. And how is the amount of the required minimum distribution calculated for each year? Well, it's based on a schedule that is provided by the IRS. So what are examples of a pre-tax qualified account? Well, it would be your employer benefit plan, such as a 401k, 403b, or a 457b. And it can also be a traditional IRA if you're making pre-tax contributions into that IRA. So what about a Roth IRA? So if you remember, a Roth, you pay taxes on the amount that's contributed into the Roth IRA, and then you never pay taxes again. So since you're not paying taxes on the amount that's withdrawn from the Roth IRA, then you're not subject to the RMD schedules provided by the IRS with respect to your Roth IRA. But that's not going to be true for those qualified accounts in traditional IRA. They are subject to the required minimum distributions that the IRS has laid out in a schedule. What about a fixed annuity in a qualified account? Because you can put a fixed annuity in a qualified account. So you will have to start receiving those steady income streams no later than the age of 72 in a qualified account. So if you set up a deferred income annuity in a qualified account and set the age for withdrawals to start after the age of 72, nope, won't happen. You will have to start receiving that steady stream of income payments from your fixed annuity no later than the age of 72. So now you can see how it is important what type of an account you put your fixed annuity in. Now, if you obtain a QLAC, also called a Qualified Longevity Annuity Contract, into a qualified account, you can actually delay those withdrawals from that fixed annuity up to the age of 85. So a QLAC makes an excellent tax planning tool in a qualified account. Leave me a comment in the section below and let me know if you have a fixed annuity in a qualified account. Also, if you're enjoying this video, be sure to give me a thumbs up. subscribe to my YouTube channel, and don't forget to hit the notification bell so that you can receive notices when I post a new video. One thing to note about a fixed annuity in a qualified account is that the amount to be withdrawn from your fixed annuity is not based on a required minimum distribution schedule provided by the IRS, but actually the amount that was set in the annuity contract. If you look at this graph, you'll see how your required minimum distributions on retirement assets are computed using the schedule prepared by the IRS. Your required withdrawal amount will be different each year. It'll increase over time and then decrease in your later years in retirement. Now, as you can see with this graph, you can receive the same amount each year from your fixed annuity if the contract is set up as such, and you possibly could receive more income from the fixed annuity contract than the amount of required minimum distributions on your retirement assets each year. And if the annuity provides lifetime income, as demonstrated in this graph, you cannot outlive your money in retirement. The same is not true for your retirement assets. If you are withdrawing more than the required minimum distribution each year, especially in the midst of market downturns. If you're interested in obtaining retirement insurance in the form of a fixed annuity for the financial security, happiness, and certainty that it can provide your retirement, be sure to click the link below to apply to become my client. Also, if you enjoyed the video, don't forget to like this video, subscribe to my YouTube channel, and don't forget to hit the notification bell so that you can receive notices when I post a new video. Also, be sure to share with your family and friends. Thank you for watching. Let's get the conversation started on how you can live your best retirement while not outliving your money.